Well, we moved past the US CPI number, and despite some hawkish repricing at the front end of the US bond market and the US dollar finding its mojo again, we're seeing equity market resilience as junk stock take us higher. We focus on all these factors and more in the trade-off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing all the landmines, all the factors that are going on in this crazy world of financial markets. I'm going to bring the great man straight into the program, Mr. Blake Morrow. When you're not looking at balloons in the back garden at the moment, I guess you're probably looking at markets which are fairly sanguine. I want to say, if I look at implied measures of volatility, whether it's in the VIX, whether I'm looking 1 month euro dollar vol, gold vols at the moment, both realised and implied, they're at the bottom of their 12-month range at the moment. So, yeah, whilst there's a lot of fear and concern out there, yeah, we are seeing implied levels of volatility, statistical levels of volatility is pretty low. Are you feeling that kind of sanguine attitude in markets at the moment?
I am. I feel like the market's kind of sleeping at the wheel right now. We're in a really tight range. Volatility has kind of dropped off. And, you know, it's interesting, Chris, when you have these pieces of these data points, like the strong jobs number, the higher than expected CPI number, the market just kind of brushes them off. You start to wonder, does the market even care about this data? And one of the things that I've learned over the years is the market doesn't care until it does. And then when it does, it all matters. And everybody's going to point their finger at the stronger jobs data, the CPI data. So I guess the point I'm trying to make here is, I think you need to be very careful of falling asleep at the wheel right now when the market seems very sanguine, as you pointed out. I think the market has the opportunity to really, take off and find some direction here in the next couple of trading.
I'd love to buy some volatility right now. Never short a dull market, as they say. I think we're going to start seeing a higher volatility coming through, but right now, I think options are playing a big part here. Everyone's been focused on, these at the money, or should we say, the zero DTE, the daily expiries, effectively. There's so much of that going on there. It's suppressing volatility and it's pushing risk higher. So I think that's a big factor. Anyway, I want to talk about all these factors with your beautiful mind, Blake. Let's go into topical thunder. Okay, I want to start with the US dollar. I know that the front end of the US bond market is kind of where it's at the moment. We've been focused on the rates market and the terminal pricing. We're currently trading just with the market feels very strongly that the Fed funds pricing is going to be sort of that 525, 550 range. But you've seen that 2-year Treasury moving up from just over 400 basis points, 403, I think it got to on the 2nd of February. And we got to a recent high of 469. So we put on 66 basis points in 9 days, effectively, of yield in the front end. Fives also went for the move. And that's really propelled the US dollar higher. So I think positioning's still fairly light in US dollars. I don't think it's overly rich. But the US dollar now is really driving things, and it's obviously impacting gold. It's not impacting equities as much as I probably thought it would do. I would think equities, and we can talk about that, the fact that the discount rate's been moving higher, real rates have had a little bit of a move up, and the dollar's been moving up. I would have thought that the NASDAQ, for example, would have been hit, but it hasn't, so that's an interesting one. But the dollar now is looking pretty good. We're seeing good buys against I think you've got to keep an eye on that yuan as well. Dollar's really moving up quite nicely against the Chinese yuan, against the yen. We're seeing core shorts now in cable. Euro dollar's had a little bit of a move lower. So the dollar's found a bit of form based on what we're seeing in the front end of the yield curve and the repricing there. How are you seeing it? Short term, I'm getting a gun to your head, Blake. What's your view? Bullish, bearish?
I'm bullish, and I'm going to be talking my book a little bit today with my dollar.
Talk it up.
I will be talking it. And I've been establishing some dollar positions over the last few days, even ahead of the CPI data, and holding on to it over the last few days. But what we're starting to see is the dollar really break out against certain currencies. The euro 106.50. I think it's really key support. It might even get taken on sometime in your time zone here in Asia, but I think the 106.50 level is really key. That big double top I know we've discussed it on a few different occasions here. The other trade-off shows discuss it. The big double top and the sterling's starting to shape up. You look at the Kiwi broke an ascending channel today in North American trade, and it closed below there. So, yeah, and then obviously the dollar yen's breaking out. The Swissy is just very close to breaking out. And, when you have all these dollar pairs are all starting to get in line, all facing the same direction, that's a really big warning if you are bearish the dollar. If you're bearish the dollar and you start to see these breakouts really take hold and mature, you could really get a cascading dollar event higher, and that could bring the euro back down towards the 102, 103 level. So
I think there's so much going on, though. I mean, I just want to interrupt.
Go ahead.
Yeah, we had this really. Europe was looking better. That's been priced in. China has obviously had the reopening, and that's seen some really good signs in some of the activity data in China. It's obviously benefits the Aussie and some of the proxies there. But the data in the US has been really strong recently. I mean, everyone's getting a job, it seems. Job openings very strong. Non-farmers obviously going nuts. You got 3-month annualized inflation at the moment. Running at 4.6%. That was 3-month annualized was at 3.1 last month. So it's, that's moving up. You saw the New York Empire manufacturing numbers last night, really good retail sales. So the US economy is in a pretty good spot, and that's incentivizing dollar long. So I share the idea. Keep an eye on that dollar CNH. I think that's really, really integral. Doesn't get a look in from retail. I think that's really, really important for that dollar. If that keeps going up, I think the dollar keeps going up as well.
And it's a good point, because a lot of the people that I trade around, and a lot of people in my world, if you will, are North American traders. We don't focus so much on the US dollar CNH because most of us can't trade it. So I'm glad you brought that up. The next topic I really want to bring up is something you've been brushing on, is the move that we're seeing in the bond market. But it's not just the US Treasury market. It's not just yields in the US. But you're starting to see, you see the boons are moving lower. You're just seeing yields creep up higher across the board. And I wonder, you get in this situation where you're seeing the bond market move lower. At what point do traders start looking at that move in the bond market and really start, pulling money out of equities? You got equities that are elevated. Start pulling money out of equities to get them in a more fixed income type of investment vehicles. I mean, how do you think that this move in the bond market is really going to affect, stocks moving forward? Because I think we're getting close to that inflection point.
We are.
What are your thoughts here, Chris?
Well, this is, I mean, when you sort of theoretically trained in equities, you look at these things called the equity risk premium, the ERP, which is looking at the premium people are demanding to be in equities over bonds. And really, we're looking at the earnings yield in the S&P, for example, and then we're looking at that relative to the risk-free rate. Now, traditionally, you would use the 10-year Treasury. I would actually use the 10-year real rate, because that's kind of the real cost of capital. And you can see that equity risk premium is the lowest since 2007. So it doesn't really give you that appetite to go out and buy equities based on the earnings yield that you're getting in the market. And that's traditionally what a lot of people would use as to define that asset allocation between the two. But, right now, equities are going up in the US on growth. They're going up on junk. I mean, I don't want to say Tesla's a junk stock. It's not. But, it's breaking to new highs. It looks bloody good, right? Have a look at that for a trend following system. And then you've also got a lot of the junk stocks, which are doing really well as well. So growth, tech, and junk have been pushing the market higher. And so a lot of people would say that's just not sustainable when you've got the discount rate in bonds moving higher, which makes the cash flows of these non-producing cash flow companies, well, tech obviously produces good cash flows, but traditionally when the bond market is going up, what you're doing then is you're discounting these cash flows that you're assuming these companies are going to make and deriving a net present value for the company. And of course, that net present value is falling as the discount rate goes up. So yeah, when you're looking at equity risk premium, when you're looking at the discount rate, you would say that equity should be going down. What we're not seeing is that situation. People, it's going up. So that makes me a big sort of light bulb moment going, what's going on? And I think in this environment, for me, the classical theoretical things go out the window and you say, look, think less, make more, and just go along for the trend is my opinion here.
Well, I don't think that's definitely worked. And that's something that maybe, you just think less and just go, you just fast forward this video and get over to our setups, and maybe that'll do it
But
for you, right?
I mean, everyone's trading these. As I say, everyone's trading these daily options. They're about 40% of the options market at the moment, and they're buying just out the money. And it's just people. It's suppressing vol. Dealers are having to hedge that by buying the underlying, and that just keeps pushing up. So I think ultimately the options market is, everyone's saying, why is this doing it? What it's doing? But there's a lot of crazy stuff that's happening, and I think options markets, these zero DTEs, I think are largely responsible for what we're seeing as well. So so it's something that we're sort of having to get to grips with there. So an interesting one. Anyway, I want to talk about the data in the and we're focused on the US, of course, but it's a very US centric show today. So we should have a nice US flag in the back. But that's the way we are. I mean, the US data right now is really essential to broad cross-asset moves that are taking place that affect volatility, that affect everything that's going on. I mean, we look at the US data, as I talked about, the New York Fed Empire numbers, great. Non-farm payrolls, great. Job openings, great. Services ISM, great. We can go into payrolls. US CPI numbers, as I say, which has muddied that sort of disinflationary narrative that the market's been running with. And I think that when core PEC comes out on the 25th of February, it'll probably be around 4.3, 4.4. And I think that you're going to see core PEC stay around those kind of levels for a number of months at that point. But Blake, I've got some data in my head now. We talk about this low volatility environment. The market is data dependent. The Fed are data dependent. So we need this data now to spur some volatility back in the market. So looking through your crystal ball into the future, have you got some dates and some data that you've got in mind?
Yeah, I've got New Zealand visitor arrivals that is really hot.
Okay. What? Didn't expect that. I didn't expect that one. All right, go on.
Sorry. Actually, I'm going to talk about it here in a moment, but I think producer prices is going to be a big deal.
The best one in New Zealand, though, the best one in New Zealand is the truckometer.
The truckometer, is that what it is? That one's great. Oh, man, those are good. No, but look, I by the way, I've always wanted to visit New Zealand, by the way. So I wanted to add to that.
It's one of the most beautiful places in the world. Absolutely.
Yeah,
South Island
I still think that I know I hate to wave the American flag here, but I do think the jobs data is going to be vitally important. So anything that has to do with with wages, I think you got to keep an eye on.
10th of March is the next payrolls number. 10th of March.
And I thought I knew it was going to be strong. I didn't think it was going to be as strong as it was. Obviously, I think, it obviously caught everybody wrong-footed. But, I think inflation and jobs still is key. Like next week, I'm really haven't been too focused on like Canada, but next Tuesday, I believe it's less than a week from now, I'm going to be looking at the CPI data out of Canada. That's going to be important. But I think we still have to really focus on jobs, because that's what is that strong jobs picture is going to keep not only the Fed, but other central banks engaged with higher rates. And until that changes. But how about you?
No, exactly. I think you're right. Payrolls 10th of March. So there's a long time before the next big tier 1 data release, 10th of March. So that to me suggests that markets could grind a little bit higher as in this low vol environment until we start thinking about that. The next CPI print is actually 4 days later on the 14th of March. If I look at forward implied levels of daily volatility on the S&P, that's the big one. It's trading around 31%. So that's the one that the market is buying volatility over. And I think that's misplaced. I think that CPI number, given what we saw from the CPI number this week, if we get another one that 3-month annualized rate continues to go higher, and goods inflation has actually started creeping up for the first time since September, I think that terminal rate could push a little bit higher, and I think that's where things get a bit real. So we don't have a lot of data now until the 10th of March. Certainly Canada, you can go into regional ones, but the US, which drives the world, 10th of March and then the 14th of March. So it's a bit of a way away, unfortunately. So we're probably in a bit of a holding pattern until then.
We are, but will we be in that much of a holding pattern? Because let's turn to our last topic here. I want to talk about producer prices, and there's a few questions I actually have for you, Chris. Being you're more of the macro beautiful mind that we like to hear from.
Beautiful face,
producer
beautiful
prices,
mind.
Wouldn't it be interesting? Everybody this week was really highly expecting the CPI data to be the market mover. Wouldn't it be very interesting to see Friday's producer prices be the market mover this week? And the reason why I wanted to ask you this question regarding producer prices, is it going to be important to you? First of all, This is the, at the production level, this is the inflation that is passed on to the consumer, where the consumer will actually feel it, months from now is what the producers are feeling right now. And that data is going to be released on Friday morning in the US. And so, are we going to be looking at the core number? Are we going to be looking at just the headline number? And is it going to matter to you? And which comes first in your book? Is it the chicken or the egg, or is it producer prices first, feeds into CPI later? What are your thoughts?
Yeah, so it is important because you're right. There's a margin issue here. So what the producers are paying for and then what they're ultimately passing on to the consumer. So there's a bit of a lag effect between the two. But people do look at the difference between PPI and CPI and then work out what that means for business profitability. So there is a stronger correlation between PPI and business profitability. But that said, the market's been pretty sanguine around PPI for a long time. And whilst it has these big moves on CPI, it's quite reluctant to do too much on the PPI number. So whilst I do think it's really important, not just for profitability, but it also feeds into the PCE number. So this is the PCE inflation that the Fed obviously look at much more closely and set policy to over CPI. When you're coming out, why the market doesn't move on PCE inflation when that comes out, because what happens is we get the CPI component and then we get the PPI component, and then we can model that to understand very, very effectively what the PCE is going to be. So no one's ever surprised. And so that's why the CPI number is always the volatility one. But we can't come up with a PCE outcome until we've got that PPI number. So that's why it's important, because it give us really clear confirmation that the PCE number is probably on a core basis going to be around about 4.3, 4.4%. So that's why it's important. It's important because it tells us about business profitability. It's important because it helps us understand the PCE number, which the Fed set policy to. So that's where it is. But the market, unless you've got a really big blowout, I don't think it's going to move too much. Yeah. So I think if it comes in line, if it comes in, misses by 10 basis, but a little bit to the upside or the downside, I don't think it's going to do too much. It's where the market gets very shocked on a wings sort of outcome that we do. But it's important, as I say, for profitability, and it's important because it gives us that PCE understanding, which, as I say, comes out on the 25th of February.
And again, the reason why I bring this up is, we were shocked with the jobs report. We were shocked with the CPI, both outsized numbers. How about if producer prices gives us the same thing? Third time's a charm, Chris.
Anything that kicks a bit of life back into this old dog, I'm very happy to see, to be honest. But I love a bit of vol like the next person. So let's hope we can get some of that. So PPI, if that's the thing that drives us, then so be it. Happy days. Anyway, let's go into that setup. Let's look at some of the technical patterns we're looking at. I'm excited about your charts, Blake. You've been on a roll. You've been bringing out some big guns recently. I can see that already looking down at the... which way is it? That way? It's that way. You can have a look, and you can see they're all very dollar related. But that's where we are. That's kind of the world we're in at the moment. I'm going to go dollar yen. Let's start dollar yen. Why not? I probably should have used dollar CNH, the offshore yuan, because it looks very similar. But what I like about this, obviously, you've got these channels which have been brewing in a lot of dollar pairs. I think you're probably going to bring that up in dollar Swiss. But dollar yen's been a really good play. If you want to trade the 2-year treasury, which, as I say, has gone from 403 to 469, if you want to play terminal rates, then you're playing dollar yen, really. And now we know that there's a new governor in town at the Bank of Japan. He said that the current policy seems fitting, so there's not going to be this radical change in yield curve control anytime soon. So we maintain this view that the yen continues to be your primary funder if you want to go and buy carry effectively. So your MEXs, your Brazilian reals, your dollars in this case. It looks good though. It's broken the channel, but what we're now doing is we're trending high. We're making higher highs, and you can see that the 3-day and the 8-day exponential moving average are aligned, and prices above that. So, can this go? Can it squeeze up to 136? Can it get to 137? I think it's not going to go up there in one go, but I think that the balance of probability suggests that this goes higher. What do you think?
Well, the 136, 137 level, actually closer to 137, is the 200-day moving average, and it's also the 38% retracement. And ultimately, Chris, if I look for trends, if I I look at the dollar yen and it's peaked.
Hang on, I did draw the 38.2% retracement.
Oh, okay, I could barely see it, but yeah, so right up there, 136. You probably have around 136.60, somewhere around there. The 200-day moving average is right next to it, and that should offer some pretty good resistance. And if it can hold that means that, you know, a 38% retracement, shallow bounce might actually lead us to new lows eventually, because, you know, the BOJ, new BO in and UDA, and how do you pronounce his name?
Yeah, I think
Maybe?
we'll go with that. It's fine.
Something like that. Okay. He may say something right now, but when he's in the driver's seat, actions are going to speak louder than words. So I would be actually looking to sell into that level if we saw it.
Yeah, cool. And I think the other thing is as well is the Bank of Japan, like the inflation data now matters. There are people out there closer who follow Japanese economics, make predictions on Japanese economics, who are saying that inflation, whilst it has moved up, you know, to about sort of, what was it, 4% or so, is now peaking. If that is challenged, then the next CPI number, the national CPI number, comes out and it continues to move higher. That could make that the next couple of BOJ meetings very interesting, especially when Kuroda steps down on the 8th of April. Yeah, the new guy comes in town and inflation continues to move higher. That could be very, very, very interesting. We don't look at Bank of Japan meetings as much as we do ECB, Fed meetings. But from April, I reckon the Bank of Japan meetings, especially if inflation keeps trending higher, is going to be where the money's going to be at.
I think your time zone is going to be a lot more spicy in the next 6 months.
Bring on the spice. Bring on the spice.
Bring on the volatility, baby. All right, let's turn it over to the dollar Swiss. And this is actually a setup, and I called it the Victorinox. I don't know if you know that the Swiss brand Swiss Army changed their name to Victorinox in 1921. That's a little, you know, hopefully you guys get, what's that game where you have to guess, like, no facts?
Trivial Pursuit.
There we go. Yeah. There's one for a Trivial Pursuit game. But the dollar Swiss, or the Victorinox, we can call it, a couple weeks ago, it was a setup for me looking for a move lower towards the lower end of the channel and looking to go long.
Sorry, is actually the pair called the Victorinox? Is
no, it's not. It's not. I'm just throwing that out there.
Okay, go so.
Little useless knowledge. I call it the Swissy, but I didn't want to say Swiss nice. I didn't want to say Swiss cheese, so I just said Victorinox. How about that? Now it's right up against channel resistance. I'm looking for a breakout above 93, and a breakout above 93 cents. If yields continue to rise, dollar yen continues to rally, euro breaks 106.50. I think the dollar Swiss is poised for a move higher. And yes, I am talking my book. Yes, I am long. However, when I look to add to new positions, I act just like they are non-existent, and I'm just starting to a position. If that position looks like I would take that trade right now, even if I didn't have a position, that means it's a valid position for me to add to, as long as it's within my portfolio or my personal trading account risk parameters. So, Chris, what do you think about the dollar Swiss here? I know you like the dollar yen, but what about the Swiss?
I think it's absolutely fine for you to talk your book. You're not trading a micro stock where you can move the market. You're talking about a $7 trillion a day market, to be honest. So people like it, I think, when you actually got skin in the game and you're talking about those positions, because if you lose, they lose, whatever. You know, so I think it's good, right? But again, I think I'm concerned about, I will put it out there, I'm concerned about buying the dollar based on treasury moves, because I think at the front end of the market has had a big repricing. I think it's oversold. I think yields, I'm not going to call the top in yields, but I think they've had a big move, and therefore you could see some consolidation. But the dollar positioning, I think, is where you get the extra kicker, right? The world is not long of US dollars at the moment. We've had a nice move up, obviously, but I think the market is still not structurally particularly long of US dollars. And as the US becomes a sort of more exceptional story, the economy is not having a hard landing or soft landing. Everyone's talking about no landing now. But, price is price, and that's what we trade. And if you get the breakout, a lot of breakouts obviously fail. That's why you have, in breakout strategies, often a sort of 40-45% win rate. But you've got to get the juice on those trades when you do. So buy the breakout for me. Cut it if it's a failed breakout and let it run. That's what you're doing with the dollar Swiss there, in my opinion. Anyway, I want to go to gold, because obviously the one of the marquee products at Pepperstone, one of the ones that we see all the business in. And everything was getting all very excited into 1950, but we've seen that massive blow off top, haven't we? It's been a big move lower. And I think if I look at my correlation matrix and I look at the relationship both on an R2 basis, but also on a correlation basis as well. And I can see that when I look at things like real rates, 2-year treasuries, 5-year treasuries, the dollar, all these kind of first derivatives and variables, the one that's actually got the closest relationship to right now is the 2-year treasury. So as yields are going up, gold prices are falling. And gold's been falling in all currency terms. I know like after overnight we did see gold rally in sterling terms because sterling had a big move lower. But gold's falling in pretty much over the last 5 or 6 days in all currency terms. So it's a gold play. But it's also, of all those variables, real rates and everything, it's the 2-year Treasury which is having the biggest influence there. So the thing for me now is this is trending lower. You can see the moving average studies that are, just sort of take the emotion out are pretty well defined. It's rallying into those short-term moving averages and selling off. I'm a seller of rallies at the moment. How are you playing this?
Well, last week, I said it's waving the white flag. That means gold was giving it up and calling a truce. And you can see it continues to sell off. My flag pattern target actually takes us below 1800 towards like 1785, somewhere around there, near the 200-day moving average. And look, I don't think it's going down there today or tomorrow, but I think we are going to trend down towards those levels. But I like gold to the downside. I think selling rallies makes sense, especially while it's below like 1880, 1900 spot. I think while it's below there, you continue to play it to the short side.
You put this out. I remember you instinctively now. You put out the bear flag, and we both said, wait for the break. The break's happened now. This was we had that ferocious sell off, as you can see, that 2-day sell off. You got the bear flag played. That's now complete. So you'd be targeting 1760 based on that bear flag, wouldn't you?
Yeah, I have it at 1780 something. Let me look. It's actually 1783 based on my drawings. But that, technical analysis is a lot like horseshoes and hand grenades.
Go on.
Approximation matters. So, we get somewhere around there and, you're complete, right? Okay. So I like gold. I like it. I think it's a great setup, Chris, and I like it to the short side. I think selling rallies is the way to go. Hey, the next setup I want to bring you, speaking of gold, I'm going to bring you over to Dr. Copper and the Aussie dollar. Direct correlations we don't look at all the time, but I love it when they start to fall into place. And we're talking about dollar strength. We're talking about the yen. We're talking about the Swissy. You're talking about gold, which is the anti-dollar. Gold goes down, the dollar goes up. Copper is threatening. Copper is that candlestick channel you see there. We're really, getting very, very close to support. And I'm looking at that copper channel support coming in right around 398, somewhere around there. And if that breaks down and the Aussie starts breaking below the 69.50 level, I'm sorry, it's 60. Let me just make sure I got my numbers correct here. 68.50. We start breaking below 68.50 in the Aussie. Then we got this head and shoulder pattern that plays out. So I'm looking at this breakdown in copper, possible breakdown in Aussie, and we got a head and shoulder pattern. What are your thoughts here on the Aussie copper correlation and the way they're looking right now?
Well, there's a few, isn't there? I mean, as your chart says, I think really short term, $4 per pound in copper is your sort of range that you've established. If it breaks the downside, then there probably will be some downside. But yeah, I mean, I think the correlation with the reverse correlation with dollar yuan is also there as well. So as the dollar's rallying against the yuan, you're seeing the dollar rally against the Australian dollar. So that's obviously one that you want to keep an eye on. You've also seen Chinese equity markets, having about a 10% correction from their recent highs as well. So some of the euphoria around the reopening has come out of a lot of these China proxies, and I think that's kind of where you've seen that Aussie weakening. And there was saw RBA Governor Lowe yesterday coming out with some fairly hawkish, dovish comments relative to expectations, and he's seen a little bit of heat coming out of terminal Aussie rates pricing as well. He said that policy is restrictive and other factors as well. So, yeah, I think that the technicals are true. If it breaks the uptrend, if copper breaks $4, then there's probably going to be some tailwinds. And copper breaking $4 will probably be a reflection of how people are feeling about the whole sort of China situation as well. So, yeah, I think the Aussie goes along for the ride. Yeah, I think that correlation's a good one. So, yeah, I like people love that ability to overlay charts and trading view and to be able to see the relationships, because relationships come and go, right? And correlation, not causation, or the other way around.
Do you know what people love in TradingView? The ability to trade through their trading accounts into TradingView, and that's what Pepperstone does. I love it.
Yeah, thanks, mate. And also the trade-off is there as well, so yeah, keep it going.
Oh yeah.
Anyway, let's go to play of the day. Let's see what's going on. Last week I called sterling CAD was my play. That's come down quite nicely. Obviously the UK inflation numbers came out low ball. We're actually right on support now. If you bring up sterling CAD, sterling Swiss also looks pretty weak. Actually, cable's probably where the weakness is really being seen at the moment. We've got a bear flag there. So sterling's your whipping boy at the moment. We've seen a bit of repricing, not for the March Bank of England meeting, but for the May meeting. That's going to be a really interesting one. So I'm just going on topic. My Swiss producer is about to chuck his hands in the air at the moment, like Andre Rio. But you're going to see a situation where that May meeting's up for dispute. There's a 50% chance of another rate hike there. That's going to be pretty lively. So one to watch. But I've got the NASDAQ 100 here. Why have I got the NASDAQ 100? Well, there you go. I mean, again, it comes into what I did. You've got the dollar strengthening. You've got front-end yields moving up. You've got real rates moving up. The NASDAQ should be going down, in my opinion. But what we've seen is we've seen market come back to that form of breakout. It's found support. It looks like it wants to break out again above that sort of 12,900 level. Now Tesla's looking pretty good at the moment, but for this to really work, we need Apple above 156. That looks like it's pretty strong at the moment. Apple is showing good leadership. I'd like to see Microsoft push through 275, Alphabet into $100. These are the sort of the leaders. If we get those doing what I do, and of course it's a big hypothetical, it's a big if. The NASDAQ's going to continue trending higher, but everyone's saying right now that this market should be lower. JP Morgan, Goldman Sachs, Morgan Stanley, Mike Wilson, all putting out bearish notes saying that the equity risk premium's too low to justify this, that valuations have become stretched. This is a bear market rally, but it's going up. And if these stocks continue to do what they do, then I want to be part of that, and I'll take heed of their rationale, which is why you listen to sell sides, because it's their logic you're interested in. But if the market's going up, that hurts if you're short. So this is a really interesting chart. I'm a buyer of strength into this one.
It's strong, and you can't deny it. So, my setup, or my play of the day is going to be the Euro Kiwi. Now, before I go into this, I do need to mention the Nikkei rolling over from last week, which was my play of the day. It's actually about the same price that it was last week, but I think you got to keep an eye on it. I don't think anything's been invalidated as of yet. That downtrend line's still holding. But I want to talk about the Euro Kiwi because I am a buyer this week above 171 on a breakout. It's a wedge play. It's above the 618 retracement. But there's a caveat. I do want to be out before next Wednesday, which is going to be the RBNZ meeting, which will be Wednesday morning. It'd be Tuesday night for us in North America, but in New Zealand, it would be Wednesday morning. But I think this is a breakout. It's a nice setup. I love it when we have higher lows and consistent highs. That means it's a wedge. It's building pressure to break out to the upside. So again, I'm looking for a daily close above 171. Then I'm going to be looking for a move up to 173, which would be the 78% retracement of that entire drop. So I'm looking to play a breakout, and I'm looking to play it hopefully this week.
Yeah, keep up that economic calendar, because if you're going to see the milk auctions and the truckometer and the visitor numbers, then you might want to just look at those exposures and just make sure that you're not overly exposed, over leveraged, and over positioned over those numbers there as well. But I agree, the RBNZ will be a volatility event, or it could be a volatility, or has the potential to be a volatility event. So I like the way that you're looking at that one, and you're buying strength in what looks like a really nice sort of wedge there. So good one. Thank you as always, Mr. Blake Morrow, for joining us, and also to you guys out there and girls for watching and staying on this far. We really appreciate it. Give us a like if you can, and also leave your comments. We get loads of good comments, and love to hear how you guys are trading the market and seeing the world. So we'll be back next week for more of the trade-off.